This paper is about the impact of corporate income tax audits on compliance. And it is a joint paper with Luca Salvadori, John Caragua, and Theonail Mukamana. And it's part of an ongoing collaboration between the Tax Administration, Research Center, and the Rwanda Revenue Authority. The structure of the presentation is going to be the following. First, I will motivate the study. Then I will provide an overview of the findings, describe the data, discuss briefly a conceptual framework which will be used to justify the findings. Then I will go through the empirical strategy, and finally, conclude. Now, tax audits are one of the most powerful strategies available to revenue authorities to enhance tax compliance through identify, deliberate, and the reporting of tax liabilities. They also contribute to tax fairness, as effective tax auditing implies that the tax burden is shared fairly across taxpayers. Tax audits are especially important for developing countries, and the need for revenue mobilization, which is needed in order for them to achieve the sustainable development goals, something that we have been discussing quite extensively in this conference. And they are, of course, particularly important now following the revenue challenges countries face because of the global health pandemic of COVID-19. But there's another point I would like to make, which is going to be a key to what we do in this study. As a consequence of COVID-19 and the face-to-face restrictions, we see tax authorities rebalancing tax audits towards more narrow scope audits, which are typically performed from the desk and without visits to the premises of businesses. The latest reported data from developing countries is that tax administrators do over 60% of desk audits, with the remaining being comprehensive, which are typically face-to-face and across many tax bases, and very intensive and intrusive to some extent. So one question we would like to ask and address in this paper is, does this rebalancing work for tax compliance? For instance, it is conceivable that it might not if narrow scope audits are not effective in terms of deterring future tax non-compliance. Now, in terms of contributions in this literature, there has been a significant number of important academic contributions which evaluate tax audits within a broad range of institutions, analyzing different tax bases and using different methodological approaches. Here's a selection of these contributions, and the list is not exhaustive. Being conscious of time, I'm not going to go through them, but come back to this list if I have time at the end. But it is important to emphasize at this stage that these contributions predominantly focus on personal income taxes and value-added taxes, without, and in particular, without assessing the different types of audits tax administrations perform. So this paper is going to depart from personal income tax and VAT, and it's going to focus on the impact of tax audits on corporate income tax compliance, but it's going to zoom also into the different types of audits. And as I hinted previously, this analysis is going to reveal something which is quite striking, that some of these audits, in particular the narrow scope audits, have a negative impact on compliance. But let me give you, before I do that, let me say also about the make a little bit the contribution more specific. So the objective of the paper is to study the impact of tax audits on deterring future corporate income tax non-compliance, and also study the impact of the different types of tax audits on deterring future corporate income tax non-compliance. And of course, understanding and measuring the impact is going to be very important. It is very important because it provides a measure of the effectiveness of a tax administration's audit function over and above the static, what is being verified when the audit takes place. Revenue yield of audits. And there's another point that is kind of quite important, especially when tax authorities discuss resource allocation issues. Once we know the cost of audit, we can also provide through a back on the envelope calculation the net revenue yield of those tax audits. Now, I would like to give you a flavor of the findings. So what we find is that tax audits in Rwanda deliver a sizable pro-deterrence effect on future reporting behavior of taxable income declared by audited businesses. More specifically, we find that 1 year after the audits have taken place, taxable income declared by audited businesses increases by a sizable 20.7%. Now, this corresponds to 12.3 more corporate income tax paid to the Revenue Authority by the audited businesses. This is a quite sizable number. We also find that non-compliant taxpayers drive this positive impact in the sense that the additional income reported is coming from those taxpayers who were found non-compliant when audited. The taxpayers who were found compliant when audited, they did not change their tax reporting behavior. Looking at how the different types of audits behave, we find that comprehensive, that is full tax audits, drive the pro-deterrence impact. More specifically, we find that narrow scope audits have a counter-deterrence effect on future tax compliance after 2 years. And this negative impact is quite sizable. In terms of corporate taxable income reported, we find a reduction of 23.5%, which corresponds to a reduction in corporate income tax revenues of 9.5%. Now, let me give you, let me provide some sense of the institutional setting in Rwanda. Rwanda Revenue Authority classifies businesses in terms of their declared turnover as micro, small, medium, and large. And there are 3 regimes for taxing corporate income. The CIT real, which imposes a 30% tax on profits, allowing for some deductions. The CIT lump sum, which imposes it's a revenue-based tax regime with a 3% tax on turnover, and this is typically for small businesses. And the CIT flat tax, which is a flat tax, depending upon turnover, and this is typically for micro businesses. I will not get into the details of this, except to note that most businesses are classified as small, but taxable income is reported by large businesses as expected, as you can see on this slide. We have, small businesses are the most populous tax filers, but most taxable income is being reported, by large businesses, as you can see on this graph. And here we're plotting the the deciles, which speaks to the same issue, in the sense that most taxable income is being reported by large businesses, those businesses that are in the at the end of the distribution. Now, in terms of tax revenues, as also expected, most corporate income tax revenues are collected from large businesses, in the sense that approximately 95% of corporate income tax revenues are being collected from the 10% of the of businesses of large businesses. Now, the data we have access to consists of the universe of tax declarations for the years 2013, 2018. And we also have data on risk-based audit data, again for the universe of incorporated businesses in Rwanda. We also have data on tax disputes, and we're going to be actually all the data we're using are closed cases. There is no outstanding tax dispute over the tax liabilities reported. And we're going to be focusing on the 2015 audit wave, because the data for that particular year are more complete and more sizable. There's an important characteristic of the economy is that there's a significant share of nil filers, meaning that a nil filer is someone who declares not only zero income, but also in the tax declaration, they also report zero across all items. And as you can see, most nil filers are in the micro category and small business category. There's some nil filers coming under the medium businesses and large businesses, but most nil filers are micro businesses and small businesses. But as you see, the audits performed reflect this what appears to be irregularity. So as you will see in a minute, most tax audits are on those nil filers. Now, in terms of tax audits, there are three types of audits: desk audits and issue audits, and comprehensive. But what we will be doing is we're going to be grouping together, the two, which are considered as desk audits, the desk and the issue, and therefore assessing, these two, major categories of tax audits: narrow scope audits and comprehensive. Typically, the narrow scope audits are audits conducted using information already submitted to the Rwanda Revenue Authority, and usually focus on a single tax type, a single aspect, or a single tax period, and they are desk-based. Whereas the comprehensive, these are audits which are quite intensive, in depth, in person, and also comprehensive in terms of the coverage of tax bases. Now the table on this slide shows some descriptive statistics on the amount of underreported income detected, fines, all that from the 435 tax audits that took place in 2015. The numbers are quite significant. I mean, the measurement unit is $1,000. The numbers are quite significant, and it is important to notice that audits in 2015 verify significant of the income reporting. The total audit outcome, which is the amount of income that reported, has a mean of $101,000 the total fines amount to 56. The mean amounts to 56,000, and the total audit outcome is the sum of these. Of note is that the verification and fines account for just over 62% of what the revenue authority could collect. I mean, this is the ratio of total audit outcome over collected corporate tax revenue and total audit outcome. I guess the bottom line, what comes out of this table is that there's a significant income verified, and the reported income verified from these audits. Now, tax audits across the taxable corporate income distribution follows a U-shape. Approximately 48% of the audits are performed businesses declaring zero income, and these are approximately just under 62% of those of businesses, of total businesses. And there are just under 30% of audits performed, of all audits performed, are on large businesses, and these businesses, large businesses, are 10% of the total. Now, using the micro, small, medium, large classification, as you can see here on the right-hand side, plot shows clearly that most of the businesses are small, followed by large, and then medium. Again, that reflects, the risk assessment, the risk criteria the Rwanda Revenue Authority uses to prioritize, to score non-compliance for businesses. Now we have access to the risk scores. The risk scores, this is a computerized system, and the risk scores, capture the likelihood of underreporting of businesses. And of course, this information is going to be used in the empirical analysis that we perform. Now, what do we expect from audits in terms of the impact of their impact on future compliance? So, theoretically, the impact is ambiguous and it depends on the inference. So, for instance, if after the audit, taxpayers think that they might be audited again because they found non-compliant, then they become more compliant. But compliance might get worse if the audit taxpayers think that lightning does not strike twice. So because you have been audited once, to be audited again is a smaller probability. It's less likely. It's likely to happen if so. In that sense, that tax compliance might actually worsen. So what is important here to emphasize is that what matters is the belief that these taxpayers form, based on the information they have, and actually it can go up and down depending upon this belief. But one thing that we emphasize in this paper, in the theoretical setup that we have, is that actually this belief is shaped by the accuracy of the audit. If the audit is not effective in terms of accuracy, is not very accurate, then actually compliance might worsen. Tax compliance might get worse because the taxpayers understand that the information held on them by the tax authority is not as accurate as it should be. Therefore, it pays off to increase non-compliance in the future. So the hypothesis is that the more accurate audits are, the more impact they will have on future tax compliance. Now, how do we estimate the impact? So now I turn my attention to the empirical strategy. Well, there are good and bad news. I mean, the bad news is that assessing audits requires to know how an audited business, would have behaved had it not been audited, something which is not observable in the data. Because all we see is, we see the behavior of the audited businesses. We don't see how these businesses would have behaved had they not been audited. So we need to do something again to estimate, this counterfactual, which is not observable, but we need to look for that in the data we have. And this is where the good news, come through. That there are quite a few methods now that we can use to estimate these and quite robustly. So to do that, we're going to be combining matching methods with a different approach. I'm not going to go through that, but beyond saying what methodologies we use. Now, and here is the table with the results. So we deploy a number of estimators to estimate the impact, which all agree on the sign, but they differ on the magnitude, which is something that we probably expected. They also show that on aggregate, tax audits are effective. In red, we have the estimated coefficients, which are all statistically significant. And averaging across all estimators shows that the impact of the audit wave in 2015 increases corporate income tax, corporate taxable income reported by just over 20%, and corporate income tax revenues over by 12.3%. So averaging these is going to give us about 12.3%, whereas averaging these is going to give us 20.7%. So this is for corporate taxable income. This is for corporate income tax payable, which is basically tax revenues. Now here we have the years. So as you can see, we get significance in year 1. So in years 2 and 3, we don't get any significance. The numbers are positive, but they're not statistically significant. So so what we conclude is that tax audits work, but they work only for the short run, which is 1 year after the audit. In year 2, year 3, we don't get any statistical significance. So looking at the impact of audits, without zooming into the different types of audits, we find a significant, sizable impact on tax compliance. Now, And this, graph here, confirms what I just said. Here we have the audited businesses and the non-audited businesses. This is before 2015. Okay, the audit year. As you can see, they follow the same reporting, behavior. When the audit happens, then the audited, which is the treated group, the group we have audited, the Rwanda authority has audited, compliance increases, and this is statistically significant. The downward trend on the non-audited business continues, but past 2016, these impacts are not statistically significant. And the same here for corporate income tax payable. It's exactly the same. So it's the visual representation of the table that we saw previously. Now, interestingly, by zooming into the different types of tax audits, as we discussed previously, comprehensive and narrow scope audits, what we see is that the positive impact of audits is driven by comprehensive. So here we split the data by looking at different types of audits, and as you can see, comprehensive is the impact is quite sizable, whereas the narrow scope audits has a negative impact on tax compliance in years 2 and 3, and this is statistically significant. And that's the same, for corporate income tax payable. For comprehensive, there's a positive increase in corporate income tax payable, tax revenues collected, by audited businesses, whereas when it comes to the narrow scope audits, there's a reduction in corporate income tax payable by audited businesses, and these audited businesses have been audited by narrow scope tax audits. So that's it. The interesting thing here to notice is that by splitting the by zooming in, we're able to understand better what the compliance impact of these two different types of audits is. And as you can see, it's quite surprising in some sense that in the narrow scope audits have a negative income compliance. And the intuition we have for that is what I discussed previously when I discussed the conceptual framework, is that these narrow scope audits are audits that are noisy. I mean, they are not, they're not targeting, the complete set of tax bases. They are not very comprehensive. They're not very detailed, and therefore, they might be focusing on narrow elements of the taxpayers' tax affairs, missing out on some other elements that might be subject to significant other reporting, and that provides the wrong signal to the taxpayers, and this signal is going to be affecting the behavior in the years to come in terms of corporate income tax declared and, of course, not paid. I'm not going to go through the conclusions again. The conclusions I have here repeat exactly what I just said and what I just said at the beginning. But I would like once more to say that the importance is, it is important not to look at the aggregate impact of tax audits, but also look at the individual components, just to tease out the effectiveness of each particular tax audit that tax authorities do. We think that's very important. Now, you might ask, are these results transferable to other tax administrations with the same characteristics? Is there any external validity to the study? I think the answer should be yes. So if we have if there are tax authorities with the same characteristics, the same business model when it comes to tax audits? I think the answer is yes. But more broadly, and perhaps more importantly, what I would like to say is that it is important to whatever policy intervention we do, and tax audit is one policy intervention, requires careful evaluation, because as we have seen in the study, we might get unintended consequences. That is, we might get consequences that we didn't intend to get. So my important message is let's carefully evaluate policy enacted and policy interventions. This is important. Thank you very much for listening, and I'm very much looking for the discussion.
Great. Well, thank you very much, Christos. A very interesting presentation, and one that I guess our commissioners who are attending probably don't really want to see, in the sense that your comprehensive audits are always so labor intensive that the idea is to try to be rather issue oriented, or focus on issue oriented audits. So yeah, I guess food for thought for our commissioners. Let me now hand over to Elizabeth Gavin, who's a senior economist at the IMF in Revenue Administration, who is the discussant. Over to you. Thanks, Liz. You're muted.
Thanks, Andrew. How is it that it always takes one so long to get unmuted still? Yeah, while we're waiting for the slides, I mean, Christos, thank you for a very clear presentation, and something that is a really extremely relevant. To really just start off, as I was instructed to, which is entirely relevant, to emphasize the key point, because your presentation was very clear. So unless somebody had an awkward break in that transmission, they would have understood that this is a study that uses real tax administration records from Rwanda and tracks the income reported and the tax payable by corporate taxpayers who were audited in 2015, and follows them for several years. And the key finding answers the title, and the answer is yes. The study shows that these tax audits do have a dynamic impact. When we look at comprehensive audits, those taxpayers selected for comprehensive audit, they actually show a lot more corporate income tax payable over the following year, but that is balanced by this perhaps unwelcome points, but one that needs to be looked at, of those that selected for an issue or desk audit actually reporting less income later. So the discussion points which really reinforce your concluding points, Christos, that I'd like to talk about is just to actually really amplify some reasons about why it's important to examine the effectiveness of audit and verification activities for tax administrations, and then also just touch on a little bit on LIDCs, things that we know from having worked with a wide variety of tax administrations in the IMF. Next, Cece, thank you. So 2 reasons additional to one that Christos spoke, just from our RA gap colleagues, those who look at the VAT compliance gap, as mentioned by Eric Hutton in the discussions yesterday, what we actually see is that the revenue that isn't collected due to non-compliance, most of that actually lies not in non-collection, but in fact in the assessment, in declarations, in under-declaration or in non-declaration. The other point to emphasize is that tax administrations invest significant resources. If we look at it as measured by staff, in fact, this is interesting, but not for discussion now. This increases with kind of increasing income in general, but even amongst low income developing countries, 18%, nearly a fifth of what they're spending is going into audit, investigation, verification. And this, and a further point related to that, which again picks up on the specific paper, is that most tax administrations undertake more issue audits than comprehensive audits. And that's even excluding the issue of classifying separately desk audits. Now, this data comes from before COVID. So, you know, certainly Rwanda is not alone in this. Next slide, please, Ceci. And so if we focus in on low-income developing countries, how would these audit practices perhaps influence the audit impact? First of all, we do see that they audit a significantly higher proportion of active taxpayers. That's taxpayers that they expect to be engaging by a factor of roughly 4 to 1. And secondly, amongst these audits, they report higher audit hit rates. In fact, the median for low-income developing countries, this is self-reported, but in other words, their median is 96%, in which they say that 90% of the audits that they conduct result in a tax adjustment amongst low-income developing countries. So what are the signals that sends to those who are audited and those who are not audited? So, Cece, just if you can get to the last slide. So just to wrap up, I mean, I think what this really, I'd just like to emphasize that, I mean, this paper is really very interesting and valuable piece of work, but kind of, you know, like Oliver Twist, we need more. So some questions, perhaps the one could be for immediate discussion is, how did Rwanda's audit and verifications impact the compliance of taxpayers who are not audited, the indirect effects that have been spoken of this morning? Do tax administrations in general, their audit and verification actions impact businesses that are not registered for tax, but ought to be? And to re-emphasize, given that even before COVID, most tax administrations undertook more issue-based audits than comprehensive audits for very understandable reasons, the ability to touch more taxpayers, given the resource intensity. But are there measures that administrations can take to ensure that issue audits do have a positive net impact on compliance with things, for instance, like the right communication strategy around audit and verification activities actually make a positive difference? So thanks once again for really, I think, a paper that elicits a lot of useful points and discussion points, and hopefully raises greater awareness within tax administrations of the need to really look at the effectiveness of their audit and verification program. Thanks.
Right, thanks. Thank you very much, Liz. Christos, would you like to respond to what Liz had to say?
I would love to. Thank you. Excellent points, Liz. I really mean that. And these are some of these points have worried us, quite significantly. In terms of the, what happens to the unaudited. This is something that we're trying to convince the tax authority to work on. Haven't succeeded as yet, but this is something ongoing. Yes, it's very interesting. Now, in terms of the the policy, what are the policies? What kind of policies they can enact, to reverse the negative impact. We do have some ideas that we have shared, and I think they agree with you. Some sort of communication, maybe visits to premises, and convince the taxpayers that declare tax liability. I mean, there are certain things they can do in terms of campaigns, and we're currently discussing some of these elements with them. But certainly, yes, there are things that can be done. But my message to them and to any tax authorities, whatever you do, it has to be evaluated, because again, there might be unintended consequences. I would love to discuss more, but I'm conscious of the time, and
Yeah, great. Thanks very much, Christos. There is one question, and perhaps you can answer this very quickly before we go to a break, from Justin Zaki of the TARC Secretariat. To what extent was the additional reported income translated into actual tax payment in order to complete the compliance cycle? Do you have any sense of what taxes actually got paid over at the end in Rwanda?
Oh yes, that was 12.3%, which corresponds to about 2.3% of all the tax liabilities that were paid in 2016. Yes, quite substantial, quite sizable.
Okay, well, great. Thanks very much.